While the crowd grows impatient watching price drift sideways, the composite operator is methodically accumulating your shares at bargain prices. Most traders see boredom in consolidation. Professionals see the greatest transfer of wealth from weak hands to strong. The question isn't whether the market will move, but whether you'll still be positioned when it does. For example, notice how volume dried up as price entered this trading range 3 weeks ago. Retail traders called it dead money and rotated elsewhere. But examine the tape closely. On every test of support, absorption occurred. The professional money wasn't sleeping. They were quietly building the largest position this stock has seen in months, disguised beneath the monotony of sideways action. By the time the markup phase begins, the opportunity for favorable entry will have vanished. Let me tell you something about sideways markets that most speculators never grasp in their entire trading careers. When the ticker tape shows price oscillating within a narrow range day after day, week after week, the untrained eye sees stagnation. The public grows restless. They complain that their capital is doing nothing. They abandon their positions in search of excitement elsewhere. This is precisely what the composite operator wants them to do. You must understand that large financial interests cannot accumulate the massive positions they require by simply stepping into the market and buying aggressively. If they did, price would immediately advance against them, and they would be forced to pay increasingly higher prices for the inventory they seek. This defeats their purpose entirely. The composite operator is not a gambler. He is a businessman executing a carefully orchestrated campaign. During these sideways movements, which I call the accumulation phase, the professional money is methodically absorbing every share that weak hands are willing to sell. The public sees inactivity and boredom. The professional sees opportunity and efficient execution, while the speculator checks his account and laments the lack of movement. The composite operator is building the very position that will drive the next substantial advance. Consider the psychology at work here. The average trader operates on emotion and impatience. After weeks of sideways action, he convinces himself that he has made an error. Clearly, nothing is going to happen here, he reasons. I should move my capital where there is action. And so he sells, often at a small loss or marginal profit, freeing up his capital for what appears to be a more promising situation. To whom does he sell? To the very interests that have been patiently waiting for him to capitulate. The composite operator knows human nature intimately. He knows that the public cannot endure uncertainty and inaction. He uses time as a weapon, allowing the horizontal movement to exhaust the patience of retail participants. Each seller during this phase is transferring stock from weak hands to strong hands, though he doesn't realize it at the moment. This is why I have always maintained that the student of market operations must cultivate patience and learn to read what is actually occurring beneath the surface of price action. The tape tells you everything if you train yourself to interpret it correctly. When you observe price holding within a range despite repeated tests, when you see volume characteristics that suggest absorption rather than distribution, you are witnessing accumulation disguised as boredom. The brilliant aspect of this operation is its simplicity. The composite operator doesn't need complex schemes or manipulation in the traditional sense. He simply allows human nature to work in his favor. By creating the conditions that bore and frustrate the public, he acquires their inventory at favorable prices without competition. By the time price begins its markup phase and the public recognizes that something is happening, the smart money has already positioned itself completely and is prepared for the next stage of the campaign. Now, I want to direct your attention to what I consider the most reliable indicator available to the student of market behavior, the relationship between price movement and volume. Price alone will deceive you. It can be painted, manipulated, and made to appear strong when it is actually weak, or weak when it is actually strong. But volume, my friend, volume reveals the truth that price attempts to conceal. When you study a trading range, you must become a detective examining the evidence before you. The amateur looks at price and sees only that it moved up 2 points or down 3 points. He makes his decisions based solely on this superficial observation. The professional, however, studies the volume accompanying each price movement and thereby discerns the true character of what is transpiring. Let me explain the principle clearly. During accumulation, when the composite operator is buying, he does not wish to advertise his intentions. Therefore, when price rallies within the trading range, you will observe something peculiar. The volume diminishes. The rally occurs on light volume. Why? Because there is little selling pressure to overcome, and the professional money is not aggressively bidding prices higher. They are content to let price drift upward quietly while they wait for better opportunities to accumulate. But observe what happens when price tests the lower boundary of the trading range. Here you will frequently see volume expand noticeably. Price declines, perhaps even penetrates the support level briefly, and volume increases substantially. What does this tell the trained observer? It tells him that supply is meeting aggressive demand. Weak holders are selling in fear, and professional interests are stepping in to absorb every share offered. This is what I call absorption, the hallmark of accumulation. The untrained speculator sees the price decline and the heavy volume and interprets this as bearish. "Look at all this selling!" he exclaims. The stock is clearly weak. And so he adds his shares to those being sold, completely misreading the situation. He fails to understand that someone must be buying all those shares that are being sold. He fails to ask himself, who would be buying aggressively at support if the situation were truly bearish. This is why I have built my entire method around the study of price and volume together, never one without the other. They form a language, and once you learn to read this language fluently, the market's intentions become transparent to you. When price cannot decline on increasing volume, when it finds support despite heavy selling, this is your evidence that strong hands are accumulating. Conversely, during distribution at the top of a campaign, you will observe the opposite phenomenon. Rallies occur on increasing volume as the public rushes in to buy, while the composite operator is selling to them. Reactions occur on diminishing volume as the professional money withholds support. The pattern reverses completely. I cannot overemphasize this point. The tape never lies. It may confuse you temporarily. It may test your patience and conviction. But if you study the relationship between price and volume with sufficient diligence and objectivity, the tape will always reveal what the smart money is doing. Volume is the fuel that drives price movements. Without volume, price movements are meaningless. With volume, they become revelatory. Train yourself to question every price movement. Ask not merely, did price rise or fall, but rather, on what volume did this movement occur? What does this relationship tell me about the balance of supply and demand? Who is more aggressive, the buyers or the sellers? When you develop this habit of analysis, you position yourself to trade alongside the composite operator rather than against him. There is a particular maneuver executed by the composite operator that I have observed countless times throughout my years of market study, and I want to describe it to you in detail, because recognizing this action can mean the difference between substantial profit and devastating loss. I call this maneuver the spring, and it represents one of the final and most deceptive moves in the accumulation process. Picture the situation. Price has been trading sideways for weeks or perhaps months. The trading range has become well established, with clear support and resistance boundaries that every chart reader can identify. The public has grown familiar with these levels. Many traders have placed their stop loss orders just below the support line, believing this to be prudent risk management. Others are waiting to sell short if price breaks below support, expecting further decline. The composite operator understands this psychology completely. He knows precisely where the stops are clustered. He knows the public is watching these technical levels. And so, having accumulated most of his desired position, he executes one final strategic move before beginning the markup phase. He deliberately drives price below the established support level. What happens next is entirely predictable to anyone who understands human nature. The break below support triggers all those stop-loss orders. Fearful holders who have endured weeks of sideways action now panic and sell at market prices. Technical traders who were waiting for confirmation of weakness jump in on the short side, convinced that the breakdown signals further decline. The spring creates a cascade of selling pressure, exactly what the composite operator wants. But here is what the public fails to observe. The composite operator is buying every single share that this manufactured panic produces. He is not selling. He is not joining the bearish crowd. He is aggressively absorbing all the supply that his own maneuver has shaken loose. This is the spring's purpose, to create one final surge of selling so that he can complete his accumulation at favorable prices before beginning the advance. The technical characteristics of a genuine spring are distinctive, and you must train yourself to recognize them. First, the penetration below support is typically brief and shallow. Price does not collapse into a sustained downtrend. Instead, it quickly recovers back into the trading range, often closing above the support level that was violated. Second, observe the volume during this action. You will frequently see expanded volume on the downside penetration, followed by strong volume on the recovery. This tells you that aggressive buying is overwhelming the selling pressure. Third, and this is crucial, after the spring, price should demonstrate improved behavior. The subsequent rally from the spring should be stronger than previous rallies within the trading range. The stock should show vitality and readiness to advance. If price merely drifts back into the range weakly, you may be witnessing genuine weakness rather than a spring. The spring serves multiple purposes in the composite operator's campaign. It removes the last weak holders from the stock. It traps pessimistic traders in short positions that will fuel the subsequent advance as they are forced to cover. It tests whether any significant supply remains that could interfere with the markup. And perhaps most importantly, it provides the professional trader who recognizes the spring with an excellent entry point at the most favorable prices available before the advance begins. I must warn you, however, that not every break of support is a spring. Sometimes a breakdown is genuine and price continues lower. This is why you must consider the entire context, the previous price and volume action, the duration of the accumulation range, the behavior of price after the apparent spring. The spring occurs after a period of preparation, not in isolation. When you learn to identify the spring correctly, you gain a tremendous advantage. While the public is selling in fear or shorting in anticipation of further weakness, you are positioning yourself alongside the composite operator. You are buying what they are desperately trying to sell. And when the markup phase begins in earnest, you are already positioned for the entire advance while they are left behind, confused about how they could have been so wrong. I want to share with you one of the most valuable principles I have discovered in all my years of market observation, a principle that I have come to call the law of cause and effect. This law states simply the amount of time price spends in preparation, in building a cause, determines the extent of the subsequent effect. In practical terms, the longer and more thoroughly the composite operator accumulates within a trading range, the greater the resulting advance will be when the markup phase commences. Think of this in terms of simple physics and common sense. If a large operator wishes to engineer a substantial advance in a stock, say, a movement of 50 or 100%, he must first accumulate a position of sufficient size to support such a campaign. He cannot accumulate 10,000 shares and expect to move a stock dramatically. He needs hundreds of thousands of shares, perhaps millions, depending on the stock's float and the magnitude of move he intends to create. Now, acquiring such a massive position takes time. The operator cannot simply step into the market and purchase his entire position in a day or even a week without driving prices sharply higher against himself. He must accumulate methodically, patiently, absorbing supply as it becomes available without alarming the market or attracting competition. This process of absorption requires weeks, often months, of sideways price action during which he is quietly building his inventory. Therefore, when you observe a trading range that has persisted for 3 months, you can reasonably infer that, if this is indeed accumulation, the composite operator is building a substantial position. The 3 months of preparation, the cause, suggests that a significant advance, the effect, is likely to follow. Conversely, if you see only 3 weeks of consolidation, even if it shows accumulation characteristics, the resulting move will likely be more modest because less cause has been built. This is why the impatient trader so frequently finds himself disappointed. He observes a stock consolidating for 2 or 3 weeks, recognizes some accumulation characteristics, and enters a position expecting an immediate substantial advance. When the stock instead continues to drift sideways for another month or 2, he loses patience and sells, convinced he made an error. What he failed to understand is that the cause was insufficient. The composite operator had not yet completed his accumulation. More time was required to build the inventory necessary for the campaign he had planned. I have made a practice throughout my career of measuring trading ranges to estimate the potential extent of the subsequent move. The width of the range matters, certainly. A stock oscillating between 40 and 50 has more room for position building than one oscillating between 40 and 42. But the duration matters even more. A wide range sustained for months represents tremendous cause, tremendous accumulation potential, and therefore tremendous profit potential when the markup finally begins. Consider this from the composite operator's perspective. He is not engaged in this lengthy accumulation process for modest gains. The time, capital, and effort required to accumulate a major position over months demands commensurate returns. He is building cause with the intention of creating a substantial effect, an advance that will reward his patience and planning handsomely. Your job as a student of the market is to recognize when sufficient cause has been built and position yourself before that effect manifests. This principle applies equally in reverse during distribution at market tops. A prolonged period of distribution, where the composite operator is selling his accumulated inventory to eager buyers, builds cause for the subsequent markdown. The longer the distribution takes, the more severe the eventual decline will be, because more stock has been transferred from strong hands to weak hands, who will panic and sell when the decline begins. The practical application of this law is profound. It teaches you patience. It helps you understand why consolidations take as long as they do. It prevents you from expecting major moves from minor consolidations. And perhaps most importantly, it helps you identify which opportunities deserve your attention and capital. When you find a stock that has consolidated for months with proper accumulation characteristics, you have found something potentially exceptional, a situation where substantial cause has been built and substantial effect is likely to follow. Remember this always: markets do not reward impatience. They reward those who understand that significant results require significant preparation. The composite operator knows this intimately, which is why he invests months building his positions. If you wish to trade alongside him rather than against him, you must embrace this same understanding and allow sufficient time for cause to develop before expecting effect to manifest. Let me address what I consider to be the single greatest error committed by the majority of market participants, the fatal tendency to wait for confirmation before acting. The average trader desires certainty. He wants proof that his analysis is correct before he commits his capital. He wants to see the breakout occur, the trend establish itself, the move confirmed by multiple indicators, and perhaps even acknowledged in the financial press. Only then, when all doubt has been removed, does he feel comfortable entering his position. By that time, my friend, it is too late. The opportunity has passed. The composite operator has already positioned himself completely during the period of uncertainty and is now prepared to distribute his holdings to the very people who are finally gaining confidence. This is the cruel irony of market operations. The time when conditions appear most favorable for purchase is precisely when the professional is preparing to sell, and the time when conditions appear most uncertain is when the professional is accumulating his position. Consider the logic of the situation. The composite operator accumulates during the sideways trading range when nothing appears to be happening, when the stock seems dead, when uncertainty dominates. Why does he buy during this period? Because these are the only conditions under which he can acquire a substantial position at favorable prices. If he waited for the breakout, for the clear signal, for the confirmation that everyone else is waiting for, he would be competing with the public for shares, driving prices against himself and destroying his own profit potential. The professional understands that his edge, his advantage over the crowd, exists precisely in his willingness to act when conditions are ambiguous. He has done his preparation. He has studied the price and volume action. He has satisfied himself that accumulation is occurring, and so he positions himself before clarity emerges, before the crowd recognizes what is transpiring, before the opportunity becomes obvious to everyone. This requires tremendous discipline and conviction. It means buying when your friends tell you the stock is going nowhere. It means holding while others grow impatient and sell. It means trusting your analysis when the market has not yet confirmed it. It means being comfortable with uncertainty, because certainty comes only to those who pay premium prices for their education. I have observed this pattern repeat itself thousands of times across every market and every time period I have studied. The stock consolidates. Professional money accumulates quietly. The public grows bored and abandons their positions. Then, when the composite operator has completed his accumulation, price begins to advance. Initially, the advance is tentative, a test to see if significant selling pressure remains. Finding none, the advance gains momentum. Now the public begins to notice. Look, they say, this stock is finally moving. Perhaps we should buy some. And so they begin to purchase at prices significantly higher than where the professional accumulated. The advance continues, gathering more attention. More buyers emerge. The financial press writes favorable articles. Momentum traders pile in, chasing performance. And throughout this entire markup phase, the composite operator is gradually distributing the position he accumulated during the sideways consolidation to all these eager buyers. By the time the move is obvious to everyone, by the time confirmation is overwhelming, by the time every indicator is screaming buy, the professional is finished buying. In fact, he is selling. The very confirmation that the public demands before acting is the signal to the professional that the time to distribute has arrived. This is why I emphasize repeatedly your profits are made by positioning yourself alongside the composite operator during accumulation, not by chasing the stock after the move has already begun. The period of maximum opportunity is the period of maximum uncertainty. The period of apparent certainty is the period when you should be reducing or exiting positions, not initiating them. You must train yourself to think differently than the crowd. You must learn to see opportunity where others see only boredom and stagnation. You must develop the conviction to act on your analysis before the market confirms it. You must accept that the greatest profits accrue to those who are willing to be early, to endure the discomfort of uncertainty, to position themselves before clarity emerges. Yes, sometimes you will be wrong. Sometimes what appears to be accumulation will prove to be distribution, and the stock will decline. This is the nature of market speculation. But if you wait for absolute certainty before acting, I can assure you of one thing: you will never achieve the returns that the composite operator achieves, because you will always be buying what he is selling and selling what he is buying. Your edge exists in your willingness to act on probability and analysis, while others demand certainty and proof. Now that I have laid before you the mechanics of the sideways trap and the methods by which the composite operator conducts his campaigns, you face a choice. This choice will determine whether you join the ranks of successful professional traders or remain forever among the frustrated majority who contribute their capital to the market but never extract consistent profits from it. The choice is this: will you continue to operate as the public operates, seeking comfort, demanding confirmation, waiting for certainty, or will you discipline yourself to think and act as the professional thinks and acts? Understand that what I have described to you is not theory or speculation. These are observations drawn from decades of studying market operations, from watching countless accumulation and distribution campaigns unfold, from witnessing the same patterns repeat across different stocks, different sectors, different market conditions. The composite operator's methods have remained remarkably consistent because human nature remains consistent. The public's tendency toward impatience, toward seeking excitement, toward demanding certainty before action, these characteristics have not changed, and I see no reason to believe they will change in the future. Therefore, the opportunity that exists today in recognizing accumulation during sideways markets is the same opportunity that existed 20 years ago and will exist 20 years hence. The principles I have shared with you are not subject to the whims of fashion or the evolution of market technology. They are fundamental to how large operators must conduct their business if they wish to accumulate substantial positions without driving prices against themselves. Your task now is to apply these principles. Begin studying trading ranges with fresh eyes. Look for the characteristics I have described: the absorption on tests of support, the diminished volume on rallies, the spring action that shakes out the last weak holders, the duration of consolidation that suggests the magnitude of the eventual move. Train yourself to recognize these patterns before they become obvious to everyone else. More importantly, develop the mental discipline required to act on your analysis. This is where most students fail, not in understanding the principles, but in having the courage to apply them. They learn to recognize accumulation, but when the moment comes to commit capital, they hesitate. They want just a bit more confirmation, one more sign, a little more certainty. And while they hesitate, the opportunity passes. Remember that the composite operator is not your enemy. He is simply conducting his business in the most efficient manner possible. Your goal is not to oppose him, but to identify his campaigns and position yourself alongside him. When you learn to read the tape as he reads it, when you understand the necessity of the methods he employs, when you develop the patience to wait for proper accumulation and the conviction to act before the crowd recognizes what is occurring, you transform yourself from a victim of his operations into a beneficiary of them. The sideways trap is only a trap for those who do not understand what is transpiring. For those who have trained themselves to recognize accumulation, who have developed the discipline to act during uncertainty, who possess the patience to allow the composite operator time to build his position. For these individuals, the sideways market represents not a trap, but an invitation to position themselves at favorable prices before the markup phase begins, to participate in the entire advance rather than chasing it after it becomes obvious, to align their interests with the smartest money in the market. This is the difference between professional trading and amateur speculation. The amateur waits for the move to prove itself and then participates in the final stages when risk is highest and reward potential is lowest. The professional identifies the preparation for the move, positions himself during the preparation phase when risk is lowest and reward potential is highest, and profits from the entire campaign from beginning to end. I leave you with this final thought. Every substantial advance you have ever witnessed began with a period of preparation. Every stock that has doubled or tripled in value first underwent an accumulation phase where professional money was building positions while the public saw only stagnation. The next time you encounter a sideways market and feel the urge to abandon your position out of boredom or impatience, ask yourself, is this truly a dead stock going nowhere, or am I witnessing the composite operator quietly building the position that will fuel the next substantial advance? Your answer to that question and your willingness to act upon it will determine your success or failure as a market operator. Choose wisely.